All right, I think I'm going. This is market update July 2, 2022. This is an interesting one. This is our first fiscal month of 2022. And so we have a brand new basket of stocks. Of course, we have some companies that are still with us from last fiscal year. We also have some new companies in our basket of stocks that we can look at, such as Luminen and these guys. Starbucks finally made it in. Just as a reminder, we only invest in companies that have been in business longer than 10 years. They have to pay a dividend of more than 2% for the last 10 years without ever stopping. We do allow them to lower their dividend, but if they ever miss a dividend payment in 10 years, then we cannot invest in that company. Also, we're investing in the largest companies headquartered in the U.S. or Canada. If they are headquartered in Taiwan, for instance, then we cannot invest in them. And that has everything to do with the reporting requirements that are placed upon these companies by the countries that they're headquartered in. And so we like to have not only good data, but we also want to make sure that it's consistent across the board. All right, so looking at the broad market, this month we see that 38% of the companies are above their 200-day, only 27% above their 50-day. So this is not looking good. If we go back and look at history, we know that December was the lowest point for both the 50-day and the 200-day. It looks like it was about 10% of the 50-day. I'm sorry, 10% of the companies were above their 50-day, and only 40% were above their 200-day, 45% rather. And so currently, we're looking at only 38% being above their 200 days. So we're actually a bit worse than we were in December of last year. I want to also go back and take a look at just what these charts are looking like. So again, this is the 200-day. As you can see, it starts here, 60% of the companies above their 200-day, and we're all the way down now to 30%. So we're definitely in a decline. And so I think this is going to continue to decline. Same thing with the 50-day. You see back in October when we first started taking measurements above 30%, and now we're getting close to 20% on the 50-day. So again, a declining trend is what we're seeing. Even though we're having some up months, right? Of course, the overall trend since October of last year is a downward trend. I do have to say, though, that one of the things that we look at when looking at technical analysis like this is velocity, which means, how fast, how far is this thing falling? And just looking at the chart here, as you can see, even though mathematically it is a downward trending line, it's not steep. It's pretty straight across, right? And so the 200 day is a little different, and that matters, right? So the 200-day is obviously a steeper line, means it's declining faster than the 50-day. But what that means is that even though that we are doing overall worse, that we still have relatively enough up days that it's kind of counteracting that overall decline, because the 50-day, even though it is declining, is still fairly stable. And so anyway, so let's take a look at the sectors. Basic materials, only 9% above their 200-day. This has to be one of the worst performing sectors in the economy right now, 0% above their 100-day. And so this is a sector that we definitely want to be wary of. We're currently in Southern Copper. They are a sector leading MVP, but the average return per month is not so great. Looks like CTRA is coming in much better there. So we'll be looking at what the portfolio that we're following is calling for, and to see if we need to make any changes. All right, take a look now at communications. 13% above their 200-day. which is not great, but 38% above their 50-day, which is a bit better than the rest of the market. So again, these guys are not doing anywhere near as good as they were a year ago, but they are doing relatively better than they were 2 months ago. All right, consumer cyclicals. Um, Again, the worst performing sector, only 17% above their 200-day. And but again, we got this little silver lining, 33% above their 50-day, meaning that where we are currently in the market is actually above where we were before. So we may be seeing, again, we know we're going to continue down, but we're going to have those days and months that we're going to actually shoot up quite a bit. All right, let's see. Consumer defensive. This is actually a decent looking sector, 48% above the 200-day, 43% above the 50-day. So about half of these companies are bullish because when you're above your 50 and above your 200, that means that you are moving up and onward. And so that's really good to see. Definitely a sector that we want to take a look at. We don't have a company right now that we're in. Looks like Coca-Cola is the sector leading MVP, and looks like they beat out everyone as far as monthly return. Well, almost. Kroger, ADM, GIS are right there with them. BG, a couple others, but they're definitely, I would say, sector average, if nothing, if at the least. And again, sector leading MVP, so definitely a company to take a look at. Also want to say Coca-Cola is one of the first companies that we invested in back in 2015. Quickly got out of it when they split to the Coca-Cola Europe, and we were in that one for a while. I think we made some decent money and then got out. So going back into Coca-Cola is an interesting idea. All right, energy. We know that the energy sector has been just really great. More recently, 83% above their 200-day, meaning they're doing way better than they once were. But take a look at the 50-day. All these guys are down, way down. And this, again, is over just the last month. And so we come over here and we look at some of these numbers, right? Um, get back up here. Yeah, look at this. Negative 15%, negative 18%, negative 19, negative 22. And so what I like to do is I like to take a look at these numbers because when everyone is performing horribly, it makes a lot of difference who performed the worst, right? And even though all of these companies perform poorly, who performed the best, right? And so we see right away this Enbridge, ENB, only lost 7%, while the rest of these guys were in double digits. Worst was DVN. This is a new company in our basket right now. 798 MMP. Everyone else double digits. Look at this, 5%. Oh no, this is financials. That's right here. Okay. So yeah, so MMP, TRP to a lesser extent, and then ENB, Enbridge. We do have OKE as a sector leading MVP, but the average return is not great. I imagine that maybe this average has come down more recently. Maybe it was better in the past, but as far as who's just been kicking butt, DVN, and this goes back to standard deviation. When you have these high numbers, when you're making a lot of money, when things go south, they really go south, right? But still, 7% per month is a huge number. I mean, you can almost double your money at 7% a month. All right, let's take a look now at financials. Only 10% above their 200-day, 13% above their 50-day. So definitely not the sector to be in at the moment. But again, this means that this won't last forever, right? Financial sector will definitely be there again. It's a vital part of the economy, and but who knows how long it'll take before that happens. Currently, we're in Regions Financial. Average returns not great. Not a sector leading MVP. That goes to Blackstone, which has just outperformed every single time. Kind of tired of talking about them, but um, that's what the numbers say. Um, really performing well. All right. All right. Health sector has been a surprising one. Doing really well right now. Half of these guys above their 200-day and 50-day. We're in Merck. Merck has been doing really well over the past month or so. Currently, Pfizer is the sector leading MVP with a whopping 3% per month return. Merck is sitting at 2%. And so, again, that is an opportunity for us to make a move or purchase more shares. All right, industrials. Industrials, not doing great, but not the worst though. So 20% above their 200-day, only 10% above their 50-day, which again is not great, but not the worst. Looks like the MVP is really spread out amongst the sector, and what that tells me when I see that is that it really doesn't matter which one of these guys you pick. You're going to do about what the average rest of the sector is doing. Okay, and maybe I can explain that a little better. The MVP is how many times did this particular company show up in the best performing portfolio over the last year? Okay, so Fastenal was on the best performing portfolio over the last year twice. Okay, um, if every month a different company is on the best performing portfolio, that means that that best performing portfolio doesn't really matter which company is on it, if that makes sense, because the best performing portfolio is going to typically have one or two companies that performed really well, right? And everyone else kind of chipped in, but they didn't really just carry the team. No different than sports, right? You usually have a couple superstars that's really good, and the rest of the guys are kind of just helping out. And so, while the industrial sector definitely helps, because like I said, it's not the worst performing sector, it doesn't really matter who you had in the game. Maybe Fastenal is a bit better than Raytheon, but you know, pretty much all the same. And then you come down here, these guys, EMR and FIS, weren't on any of the better performing portfolios, but their average returns are negative, and it's very possible that these companies are not investable anyway, which is why they're zero. All right, real estate. Um, Again, not the best, not really the worst, but definitely not looking good. 15% above their 200, 15% above their 50. We're currently in MPW, really happy where we are, sector leading MVP. Definitely not the best performance throughout the sector, but again, really happy with our position, looking to add more shares. It looks like trying to figure out who's really performing. DRE, WPC. We were in WPC just recently, um, and so that's really good to see. And DRE, I think, is a sort of an alternative uh, real estate holding. Not entirely sure about that, but interested to look at that later. All right, technology. Again, not the worst, not the best. Think just kind of, either you're doing really well right now in this market, or you're not, basically, as far as the sectors go. 25% above 200, 25% above 50. We're currently in Corning, and looks like QCOM is the sector leading MVP. And as far as returns goes, like Hewlett Packard, which is where we were previously, it's performing really well. Corning, not so much. Utility sector, again, MVPs kind of spread out, threes, twos, and a bunch of ones. The utility sector has been doing really well, and that kind of makes sense. I can imagine that any one of those guys you chose, we're going to get you, um, a decent return. So 85% above their 200, 65% above their 50. This might just be the best performing sector in the market right now, and that says a lot, right? Because utilities are safe investments. Okay, and when we talk about stock performances, what we're really talking about is where is the money going, right? Where are people putting their money? And based on this outlook, we're looking at utilities, we're looking at health, and we're looking at, um, you know, energy is a funny one because it's like the floor was pulled out from under them with 83% above their 200, but zero above their 100. Maybe that means there's a bounce. Maybe that means that this number continually comes down. Um, when I see stuff like this, and then you have consumer defensive, which again we're talking about a defensive play, right? This is not going after speculative, um, you know, uh, growth companies. This is going after companies that we know, if worse comes to worse, they're still going to make money because we need them, right? Altria, right? Cigarettes, Walgreens, Target, Philip Morris, more cigarettes, Kroger's, groceries, right? These companies aren't going anywhere. No matter how bad it gets, we can expect that they're going to continue to put out profit because basically they can charge whatever they want to charge, and people are still going to buy it. Consumer cyclicals we know has been bad. Really interesting with communication sector, which has been doing fairly well, and now is starting to come down. So, that says a lot about the consumer, right? Because the telecommunications, cable, TV, phones, right? Those are utilities, but they're not utilities in the sense that when money is tight, you are more likely to spend less money on phones, internet, and cable before you'll ever spend less money on lights and gas, right? You're going to put off buying a new phone before you start to cut back on your energy consumption. That's just the reality of it. So we're seeing that where the consumer was fairly strong because we saw the communication sector still going, and now we're starting to see that communication sector come down. And so I think the consumer is continuing to falter. The basic materials again say the same thing. One of the worst performing sectors in the economy right now. Uh, there is no prospects of growth. There is no prospects of cement being needed, of paint being needed, of those construction materials being needed to build, to grow, and to make more money. And so all of the money is going to these defensive plays, and that is exactly what we see going on also in the portfolios. Let me Here we go. This was disturbing to me. I looked at this for quite some time um, before I just had to come to the realization that this is just where we are. So again, every year at the end of our fiscal year, we go through and we shake up our basket of stocks. We take some out, we add some. Again, this is all based on our criteria for investing in stocks. Also, I want to say too, we don't invest in any companies whose stock price is more than $150. The reason being is because we want to make sure that we can purchase enough shares to be able to buy and sell and do what we have to do. If a company is worth, $2,000 a share, we only may be able to purchase one share, and it's going to be really hard to buy and sell just one share of stock and really do anything with it. We want to have like 100 shares of a company. So that's one of our criteria. All right, so just going through these. So the first number that you see here is the actual return, meaning that you purchased this portfolio in August of 2021 and you held it until today, right? If you sold that portfolio today, you will have lost almost 8%. Now, this does not include dividends, okay? This is just stock price. Now, what we do is we take a look at the performance of the portfolio over the last 3 years and we give it a standard deviation. I talked about that in a previous video. That gives us a prediction of where we think the portfolio can go. All right. Now, what I've done with this is worst case scenario, I assume that this number is going to come down. All right. And so that means at the worst, we're looking at a 12% drop for this particular portfolio any given month. On average, about 8%. Okay, that's kind of what we're looking at. And so what you're seeing here are just all negative numbers. Okay, all the portfolios, with the exception of this one, standard deviation portfolio, you see posted not only a positive gain, but even when factoring in the standard deviation, the volatility of this particular portfolio, which isn't very high because that's what this portfolio is geared towards. It's geared towards companies whose stock price does not move up and down a whole lot. Okay, and that's a really good thing if you're concerned about losing money. You don't want to lose a lot of money, so you don't want a stock that moves around a lot. It also means that when the stock moves up, it won't move up very high either, but there's more protection on the downside than there is profit on the upside. So again, 6%, even after standard deviation, still positive 3.5. The rest of these guys just negative, negative, negative. And this was really, it shocked me, right? Just all negative numbers. All these portfolios have lost money over the last 12 months. I mean, and some of these numbers are big. You see this 22%, 25%, 18%. This is a stark contrast to what these portfolios looked like last fiscal year. Because again, we're changing not only some of the companies in here, but we're also changing the timeline. Okay, so this is from August 2021 to current, whereas before we were doing, I think, August 2020 to current. So yeah, so all negative numbers. We do have this one that posted a positive. We'll talk about that in a second. M score up and down. The rest of these guys all negative. So let's take a look at what this looks like. Again, over on the left, these are the returns with the dividends added in. On the right here, these are returns without dividends. And the reason why this is separated is because it's important that we do know what the total return is, but we want to know how these companies are actually performing regardless of their dividend. Okay. And so we see that the top performing portfolio is the standard deviation portfolio, which again makes sense when you're in a market where there's a lot of movement up or basically if there's a lot of movement down, these companies won't lose so much. And it just so happens that these companies, I think, have larger dividends. All right, let's take a look now at the performance over the last 12 months. Again, standard deviation wins out. Next one down is M score up down, right, which is not far off from that 6%. Relatively speaking, there's a huge drop after that 4%. And so what I like to do is I like to look at what types of portfolios are performing the best. And as you can see, the top 10 all have M score in their makeup. Okay. And this also too, you can see the up portfolio as well in here a few times. But for the most part, standard deviation and M score is kind of what we're looking at. And so right now we are following the standard deviation portfolio, but I will definitely be looking at that M score to try to get an idea, especially if there's a decision to be made between one of the other. I'm definitely going to look at the M score because obviously the M score portfolios have performed fairly well. I think the standard deviation is something of a fluke, but again, we'll look at that here in a moment. All right, so also too, I wanted to talk about this. I'm sure it's been a long time since I've done this, and so I want to show. So this is a test, okay, and this was put in to ensure that the scoring parameters actually work, okay. The way this works is that if in fact you take these companies, right? Let's say you select these companies, this particular portfolio, the companies are selected because of their dividend, Okay, these are the highest dividends in our basket of stock, right? And so the program just grabs whoever has the highest dividend for that sector and they put them in a portfolio and we see how they perform. Okay, and we know that this particular portfolio performed fairly well, right? It put off $1,000 in actual dividends. But if I were to sell the portfolio today, I would lose $500 because the portfolio is currently down. That still gives us a profit of $540, which is why we have a total return of 10%, assuming that we are investing roughly $5,300. All right. Now, with that being said, if we were to get these companies and just evenly distribute them across the portfolio, meaning that we take our money, and this goes to you know, cash allocation, right? When you have some companies that you're investing in, the question becomes, how do you decide how much cash to put towards which position, right? And so, the easy, simple thing to do is simply just divide your $100 and put $10 in 10 stocks, right? It's an even distribution. What this test is going to figure out is that if we choose to put more cash into the company that has a better score, right, will the portfolio perform better? All right, that's what this test is trying to figure out. So let's take a look again. We know that the highest performing portfolio with dividends included was 16%. On a rolling 12-month basis without dividends, 6%. All right, now let's do the test. All right, let's look at the best performing portfolio with dividends, and we see that it's only 14%, and it happens to be the dividend portfolio, of course, right? If we look at the best performing portfolio without dividends included, and the money evenly distributed, 6.21% for standard deviation. Go back. Now the standard deviation return is 6.6. So not a huge difference without the dividend, but with the dividend, huge difference. And we don't even see the dividend portfolio anywhere in it's in the top, 4, but it's definitely not at the top. And again, this just goes to show that the scoring actually does make a difference, and it makes a difference in a positive way. And so that's the reason why we can use this to better our investing decisions. All right, so the portfolio that we're following, and let me do this too, because I thought this was interesting. I looked at this earlier. What are the worst performing portfolios? And we see that almost the top 10 all have return. There's some beta return, some alpha. And what this tells me is that, of course, the portfolios that make the most money on a month-to-month basis, when things are bad, they're really bad, right? And so that's the reason why these return portfolios are doing so bad. But when I see all this beta stuff in here, basically, the beta stuff is still part of this return motif in this top 10 of the worst. It does still tell me that it's not a good idea to bet against the market, right? Because that's what this beta portfolio is trying to do. It's trying to say what companies perform better when the market is down, right? And as we can see, even though it does have a positive return with dividends included, it's nowhere near the best return, not even close. And then on the last 12 months is one of the worst performing portfolios for that. So let's take a look and see again. Worst performing without the dividend. We see just a bunch of return portfolios, but we also see these betas kind of in here. And so again, that tells me, not to bet against the market. Even though we do have a declining 200-day showing that we have, more down days ahead of us, that 50-day, because it's still so sideways, that we're going to have some ups and downs, at least in the near future. All right, so this is the standard deviation portfolio. This is the best performing portfolio, and these are the companies in that portfolio. Okay, so Telus in the communication sector, this is nothing new to us. We have seen them continually perform year after year. Purchase price as of July 2, 2021 was $21. Current price is $22. So not a huge increase in stock price, and the dividend happens to be one of the highest though. And so this dividend number that you're looking at is a rank. So it's ranked 74th percent amongst all the companies in our basket of stocks. All right, financial services, CM. Don't know a lot about these guys. I believe this is a Canadian bank. Purchase price last year $56. Currently, the price is $49. So again, didn't have a lot to do with the performance of this portfolio, but the dividend is super high. I think this is just a coincidence, and we see that demonstrated here with Coca-Cola, where the purchase price was $52 and it ran all the way up to $64, which is a huge increase, right? But the dividend was only in the 36th percentile. So not a huge dividend by any stretch of the imagination, but the stock price performance has been great in that consumer defensive sector. All right, then Pfizer. We've already seen these guys, sector leading MVP, 3% a month return right now. Purchase price $38, went all the way up to $52. That's a huge increase, and probably a lot of the reason why this portfolio performs so well is because of Pfizer. Dividend, not bad, not great, 44 percentile. All right, Duke, I think we talked about this before. You can probably throw any one of those utilities in this portfolio, and it's going to perform just as well. Purchase price $95, ran all the way up to 110. Dividend is decent though, and that means something, right? All right, IBM Technology, purchase price 133, current price 141. That says a lot because we know that the technology sector is doing horrible, and these are one of the few companies that actually posted a gain. That's crazy, and the dividend is sitting at 77 percentile. I mean, that's a juicy dividend. And so we'll definitely be looking at possibly getting out of Corning. All right, ENB, we saw that name before in the energy space. Again, does have a jump for sure. I don't think this is as large of a jump as some of the other energy names have gone to, but look at that dividend, 94th percentile. So almost the largest dividend in the energy sector. And that's saying a lot because those dividends in the energy sector are huge. All right, PPG, basic materials. We know that this is not a great sector right now. Purchase price was $168, currently down to 117. And this is one of the things that I was discussing earlier. This company may not have been investable for us because it was above $150 last year. But now that the stock price is down to 117, it is a company that we can invest in. The dividend, however, is one of the worst in this particular portfolio, and they lost a lot of money. So this company didn't do any good for this portfolio. Matter of fact, this portfolio would have been much better off had it not invested in PPG, or if it invested in a different basic materials company. All right, industrials. 3M, another one of those companies that, because the stock market has fallen so much, we're able now to invest in some of these companies that were uninvestable for us before. 3M's a huge company. Everyone knows them, sells tape, whatnot, and a decent dividend, 0.77%. All right, GPC, Genuine Parts, talk about these guys a lot, have performed very well over the years. And so we'll definitely look at getting into this company. Excited about that. Purchase price 125, ran up to 133. Again, this is something that I've talked about before, but we know that the cyclical sector is not doing well. So a company that's able to post a gain in that sector is really good. And again, this company has been great for a long time now. Dividend is not that great, 0.32, but it is something. And clearly, it was some help to this particular portfolio. All right, real estate, ARE. Again, one of those interesting things, right, where we can clearly see that at a purchase price of 180, current price 148. Clearly, this company didn't do this portfolio any favors, and this is the best performing portfolio. So that means that this portfolio would have done even better had it not had this company in it, or if it had a different company. And so that says a lot. And if you look at the dividend, it is literally the second worst dividend in the portfolio. What the scoring does, however, and I want to talk about this real quick. When you do that scoring, let's see, where is it at? ARE. Yeah, so if you are allocating cash towards the stock because of the score, right? Then you only purchase one share. But if you're just dividing your money up evenly and investing in all these companies evenly, then you buy two shares. And so that's not a lot when you're talking about, $5,000 portfolio. If we were to increase these numbers, then I think you'll really get a chance to see, um, what the differences are as far as the scoring goes. But either way, it's double, right? And so, like I said, if you're able to purchase less of this company, then that's the better for you. So, um, you know, we'll look and see kind of, what's what's available to us. But let's take a look too now at the M score up and down. And actually, I want to look at not the beta, but just the return maybe. Or yeah, here we go. Return alpha is a good one. So these are the companies that we want to stay away from, right? We know that these particular portfolios are not performing well at all right now. Um, and so I want to see kind of what's in here: Target, CG, Fastenal, QCOM. We saw them, sector leading MVP. But again, based on what we're seeing here, this is a company that we probably want to stay away from. KIM for real estate, OKE for energy, MGA, AEM. That's a new one for us. CM, CSA, NEE, and then Cardinal Health. Um, turn up. See, we're seeing some of these same names because it has the return in there. But we do see some changes when you do add that up, such as Corning sitting here in technology, SWK, some new stuff, and then Pfizer down there. I think some of these portfolios can be interesting, but we're only going to take a look at a few here. All right, so the M score. Again, interesting for me because we know that the M score has been part of the makeup of all the best performing portfolios, but the M score portfolio itself has not been uh, top five, maybe top 10. Let's see. Yeah, not even top 10, which is interesting, meaning that while the M score portfolio or the M score, uh, um, what's the word I'm looking for? The M score, right? The M score does make a difference. It is necessary, however, it seems. to add something to that, meaning you can't just look for the pure M score companies, that these companies have to have something else in them to get this portfolio to perform well. And so we're going to look at what maybe those differences are. So we see that M score dividend, second best scoring, M score up and down, M score down, M score standard deviation. So uh, now that's with the dividend. Let's take a look at just performance. M score up and down, M score up, M score return alpha, which is interesting because we know that it has not, the return in alpha has not performed well at all. But the M score up and down, I think is really interesting and it's pretty high up there. So take a look at just the M score. So Regis Financial, um, it's kind of where we are. Paychex, Best Buy, Southern Copper, MPWT. This portfolio looks similar to our current portfolio, right? And so this is saying that, um, not the best performing portfolio, but obviously it's not the worst, right? Take a look and see what the difference is. Once we get to M score dividend, we're looking at that M score, but we're also looking closely at the dividend too. So what the M score portfolio lacks maybe in performance, the M score dividend portfolio makes up for it with that huge dividend, right? So Southern Copper is still there, MPW is still there. There's AT&T in there for communication services, which has a huge dividend right now, but has not performed well at all over the years. And then we see IPG, PPL, Cardinal Health again. And so, again, looking at just how these companies have performed, Texas Instruments down from 180 to 148, but the dividend is, um, the worst performing dividend here is zero point 0.4 versus like 0.12 or 0.13 that we saw in the other portfolio. I mean, that says a lot. These are huge dividends here. MPW, we know their dividend. IEP has like the highest dividend in all of our basket of stocks, and that's in the industrial sector. So that's what's going on here. The other one was the M score return alpha is what I'm interested in. There we go. And I'm going to look at M score standard deviation too, just because we know the standard deviation has performed well and M score has performed well, but the M score standard deviation portfolio itself um, has not done so well, which is weird. All right, so M score return alpha, again, looking at the M score, but we care quite a bit about the return and the performance of the company when the market is performing well. And so we see a lot of these companies that we saw in that return portfolio, Fastenal, QCOM, Target, but we see some other M score companies in here like Regions Financial, which is interesting. DVN, we saw them in that table just kicking butt in that energy sector. 7% a month is crazy, and it's kicking out a huge dividend, 0.87. That's up there. And then Cardinal Health again. So we keep seeing some of these names over and over again, just to kind of give us an idea of again what to kind of stay away from, and what to kind of go towards. Target is really interesting. Purchase price of 242, current price all the way down to 142. I mean, that is a huge drop, and the dividend isn't that great. So again, you're talking about a company in this portfolio that obviously has not done well at all, and is the largest holding for this portfolio, and it's still, even after all of that, um, you know, kicked out at 8% loss. But like I said, it's still second um, behind the the standard deviation portfolio. Well, no, wait. All right. It's M score up and down. Now return alpha. Yeah, there we go. Yeah, the return alpha again, obviously not where you want to be, but Some of that M score stuff is in there. Okay, so M score up and down. We see Southern Copper again. We see Philip Morris talked about those guys. Rogers, where we are, WPC talked about them. IEP again, that huge dividend in that industrial sector, and has not made or lost any money, even though the industrials have not done so well. And then we have Texas Instruments again, and then Best Buy again. We saw them quite a bit. So again, just a different look, but just gives us an idea of where the market is and where we think it can go. Definitely a defensive time right now, looking at that M score. But again, like I said, based on the fact that the M score by itself does not really help much. You have to have some sort of alpha, some sort of pop, right? Something like up moves, something positive, something that's going to push that portfolio when the rest of the market is moving up as well, in order to really get any sort of performance out of there. And then standard deviation, again, it is kind of in the conversation for sure. Not as much as the M score portfolios are. It is definitely there, and it has outsized um, performed the rest of the portfolios. All right, I want to take a look at this color chart. I thought this was really interesting. Dark green are the better performing portfolios for the month. Okay, dark red are the worst performing portfolios for the month. And we see just across the board last month all of these negative returns. I don't think there's any positives. Everyone lost money. To see these dark green, negative numbers is really interesting. And again, I think that just goes to show again kind of where we are in the market, right? We are headed down, but you don't want to bet against this market with that 50-day moving sideways as it is. So we're going to again follow this standard deviation portfolio for now, but we will keep an eye on the M score when evaluating these companies that we want to move into. So just want to go back just really quickly, take a look at what those are. And again, these are companies historically, by definition, that will not move down as uh, hard and as far as the rest of the market, but will not move up past what the market's doing either. These companies are going to kind of stay right in the middle. And that's TELUS for communications, CM Financials, Coca-Cola, Defensive, Pfizer Health, Duke, Utilities, but again, probably throw anyone in there. IBM is definitely a standout. E&B, I think you can throw any company in there. PPG for basic materials, I don't think their company really has done any good for this portfolio. So, um, we'll kind of uh, keep it in the conversation, but I don't think we can just ignore it. Okay, and then Triple M for the industrials, again, um, not great price performance, but again, a really decent dividend. So that's something that I think we have to take a look at for sure. And then consumer cyclical, I am more than happy without doing much study at all to get into GPC. But again, that's something that we'll take a look at for that sector. And then ARE for real estate, just to recap, again, this company has not done this particular portfolio any good at all. Simply replacing ARE with something like an MPW, I think will actually increase the performance of this portfolio quite a bit, which is where we are now.